right, well, welcome everyone. We're going to start by letting our interpreter share how to get into the interpretation channel. I will open that in just a moment.
Vamos a empezar con pidiendo al intérprete que les explique cómo pueden entrar al canal de español. Pueden presionar el globo que está en la pantalla y ese globo los llevará al canal en español.
Gracias. I'm going to open up that interpretation room now.
Voy a abrir esa sala de interpretación ahorita.
Well, thank you all for being here. My name is Jay Lyman. I'm a librarian with the Seattle Public Library, and I am going to also introduce my colleague, Elizabeth Ayukia.
Good morning. I'm Elizabeth Yokia. I'm work here with Jay Lyman at the Seattle Public Library. I'm the Adult Education and Workforce Development Program Manager. It's great to be here. Welcome, everyone.
Thank you, Elizabeth. Now I'm going to really just turn time over to Tierra Bonds, who is going to be presenting today. Tierra, I'm going to let you, I know you have things that you can share and introduce yourself, so take it away.
Awesome, thank you, Jay. Okay. So thank you, everyone. Thank you, Elizabeth and Jay, for having me and everyone else at the Seattle Public Library who's here today. My name is Tierra Bonds, and this workshop is about kind of the beginnings of credit. So we called it Credit 101. And so we will be, actually, I will show you guys the agenda. Let me move to the next slide. So a little bit about my company. So Take Charge Consulting. We believe that credit and entrepreneurship are tools that we can use to shorten the wealth gap and empower women and minorities. The racial wealth gap is something huge. And in order for us to address that, we first have to address the credit gap. So that's kind of where my passion lies within credit. And I'm just happy to be here to be able to share what I know. So a little bit about myself before we get into the credit side of things. My world revolves around family, my dog, travel, and food. So a lot of my travel, and I'm actually a nomad right now, so traveling around the US and some outside countries, working remotely and helping people with credit on that journey. And in my business, I get to help professionals and entrepreneurs with credit, but then I also get to partner with different nonprofits and organizations like Seattle Public Library and others like Habitat for Humanity to kind of help eliminate the money barrier when it comes to being able to help people with credit and entrepreneurship. So here's the agenda. So it looks like a lot, and it is, but I'll make it as easy as possible. If you have notes, please take as many as you can. We'll take breaks at the end, a break at the end for Q&A. So just write down your questions or post them in the chat as they come up. But we'll start with, what is credit? Why do we need it? Why is it important? And then I'll show a couple examples of how credit can play a huge role when it comes to different scenarios in your life. And we'll talk about what makes up your credit score, how credit is established, which is very important for this group. And then we'll get into the strategies to maintain or obtain excellent credit. And then I like to end all of my workshops with next steps. So the education and knowledge that I'm providing is pretty useless if we're not able to apply it. So I'm hoping that with the next steps, you all can take at least one thing away. That's my personal goal for this workshop. And then the Q&A, as I mentioned. And I know I'm supposed to pause for the interpreters. Is this enough time? Okay. All right. So first, the benefits of credit. So we all know that we need credit to get approved for things like buying a home, even renting. A lot of landlords will check our credit, as well as careers and jobs. But the benefits of good credit is, the difference in interest rates that you're able to get when it comes to borrowing money. So that could be for credit cards, for any type of loan, mortgage, student loans, auto loans. The better our credit is, the better interest rates that we will get when we are borrowing money. But it also plays into a role when we're not borrowing money. And the fun side of the benefits of credit that I like are the travel rewards, the travel benefits that you get, cashback rewards. And this is just for purchasing things on a credit card rather than using cash or a debit card. And we'll get into one of the differences between that a little bit later. But simply spending the same money you would, but using a credit card instead can provide you with many different benefits. And I like to call it getting paid to spend money that you already would have. So we're not using credit to purchase things that we can't afford, although it can be helpful when investing or starting a business, but just using our credit card rather than our debit card to take advantage of those rewards. So here is one example of why good credit is important. You can get approved for a car loan with even, 400 or 500 something credit score, but that's going to cost you a lot when it comes to interest. And so this is an example of two different credit scores and their differences in the monthly payments and interest over the term of the loan. So this is for a car that's $30,000. Both people are using a 60-month term for the auto loan. And where the differences come in to play is with their credit scores. So the lower credit score, a 630, which is not a bad credit score. You can get approved for many things with the 630, but the interest rate that this person would be paying is 11.3% compared to an interest rate of 3.6 for the higher credit score of a 760. And so the monthly payments are about $100 more for the lower credit score, and the total interest paid is about $7,000 more for the lower credit score within that 60-month term of the loan. So just, about 130 points difference in your score can cost you a lot of money when it comes to auto loans, as well as mortgages. So this is an example. And these two I took from a website called Self-Lender. And it may be a little dated because this is showing an average cost or a cost of a home for $200,000 and a 30-year fixed mortgage. With those same credit scores, the lower credit score would be paying 4.2% in annual interest, whereas the higher credit score would be paying 2.7%. And so what that means is, again, the monthly payment is about almost $200 more for the lower credit score, and the total interest paid over that 30 years for the lower credit score is $156,000. So that's almost $70,000 more in interest that you're paying just by having that lower credit score, 63,000 to be exact. So I like to show this example because our credit score is just a number, but it can play a big role when it comes to borrowing money. So if any of us are business owners here or ever need a personal loan, you can imagine how these interest rates can play a role in that as well. So the next portion is credit myths, which is I'm hoping can be a little bit engaging. So if you guys are able to post in the chat, just post whether you think the statement is a truth or a myth. And I think we'll be doing 3 of these. So the first one is using your credit card is safer than using your debit card. Is that a truth or a myth? And again, just post in the chat. So we've got true, true. Awesome. Awesome. That is correct. I love it. So everyone said true. Yes, using your credit card is safer than using your debit card because of all of the security that comes with credit cards that we don't get with our debit cards. So, and this is a common myth because I get a lot of people, scared to use credit cards and just feel safer using their debit card. So I like to tell them the benefits of using credit over debit. And the biggest one is safety. If there's any type of identity theft on your card, it's much easier to get it resolved with your credit card compared to your debit card. And of course, compared to cash. And then the second one, checking your credit hurts your score. Truth or myth? Awesome. So we've got some myth and some true. The answer is myth. And the wording of this can be a little tricky. So you checking your own credit score does not hurt your credit. The only time your credit is impacted is if a lender is checking your score. So an easy way to remember it is if you are borrowing money or asking to borrow money, then it's probably going to be a hard inquiry, which are the ones that impact your score. But if it's someone else checking your credit for background purposes, let's say a landlord, so you're renting, you're not buying yet, so it's just a landlord checking your credit, or an employer or insurance, those ones are more for like screening background purposes and do not hurt your score, as well as you checking your score. That does not impact your score either. So cool. And then the third one, your spouse's credit automatically impacts your credit. Is that a truth or a myth? I've got myth, 2 myths, 1 true. So that is a myth as well. So good job for is not what combines the credit, the accounts on the credit report. It's only accounts that use to specifically are both of your names are on. So if you get married, you still have your separate accounts. The only way they would be together is if you add each other's name to those accounts. Like credit cards, you can add them as an authorized user, and then that would impact their credit. But the simple fact of just getting married, your credit reports do not combine, the accounts do not combine, and everything can still be separate in a marriage if that's how you choose to do it. And then the last one, paying collections on your credit report increases your credit score. Truth or myth? Myth, myth, myth. I love it, love it, love it, love it. Because this is a huge, huge, huge myth. And this is one that I see way too often. And this is not to say that I'm recommending you to not pay debts that you may owe. But the thing is once collections are on your credit report, paying it will not increase your credit score. And that's because the way that it's reported as a collection or charge off, that part is what's impacting your score, not the balance. So you could have a medical collection that's on your credit report saying that you owe $4,000 and you can pay that off to $0. It will still have the same impact on your score as it did with the balance being owed. So huge myth. If this is the one takeaway that you get from the workshop, I am totally okay with it, because unfortunately I see a lot of people come and, you know, they've paid their debts, the collections on their credit report, and with the hopes of increasing their credit score. So then, you know, they're ready to buy a home, but their score is still low and it's still impacted by those collection accounts. So the best thing you can do is to dispute those accounts or wait until the 7 years that it will stay on your credit. And then I will take another pause here. All right. So now we're going to get into what is credit and how it's established and what makes up your score. So your credit score is a 3-digit number that represents the information on your credit report. So there's many different scoring models out there. The FICO is the most common, but even within the FICO score brand, there's hundreds of different scoring models there. So there's, you know, the FICO 8, the FICO 9, FICO 7, many different scoring models that use the same kind of information here, these 5 areas, but they might be weighted a little bit differently, or they might take into account a little bit of different things under each of these areas. So your score ranges from 300 to 850 in the most common scoring model, but again, there's many out there. And so the 5 important areas that make up your credit score are payment history, your credit utilization, or the amount that you owe on your credit cards, your length of credit, inquiries, and mix of credit. So we'll touch on these again when we talk about the 7 strategies, but just briefly, so your payment history is 35% of your score. And what this measures is your amount of on-time or late payments. And the payments in the last 2 years are the ones that matter the most. And these are only payments that are reported to your credit report. So, you know, as consumers, we pay lots of bills. But the ones that matter here for your credit are any type of loan that's being reported to the credit bureaus. So personal loan, auto loan, student loan, a mortgage, and then also your revolving accounts, like all of your different types of credit cards. So those are where they're counting the on-time and or late payments. And then also what matters here are the collections and charge-offs. So if you have any of those, it's going to impact this 35% of your score. So super, super important to work on those collections. And then the second area is the amount that you owe on your credit card, so also known as credit utilization. So this is almost a third of your score, and what it's calculating is how responsibly you use your available credit. So when it comes to revolving accounts, you get an identified credit limit, and in this credit limit, you want to keep your balances relatively low compared to that credit limit. So if you have a credit card that's you know, got a $10,000 limit and your balance is $5,000, then your utilization is at 50%. So in simple terms, you're getting 15% you're getting half of the 30% of the utilization category. And then if your cards are maxed out, then you're missing, the complete 30% of your score there. And then the third area is length of credit. So this is an average length of all of your accounts together. So they add up all of your accounts that are being reported to your credit report and determine an average length of history. And that accounts for 15% of your score. And then the last two are both 10% installment accounts. So having a good mix, just those two, you get those that 10% of your score. And then inquiries is the hard inquiries within the last 12 months. That's what's impacting you here for inquiries. So the soft inquiries will not impact your score here. And of course, you checking your own credit will not impact your score there. So how credit is established. So this is a new section that I added to the workshop because often many of us don't just start with, the basic Social Security number. So that is one route. So that's your Social Security number is assigned by the Social Security Administration. And that's what kind of, that's what your credit is attached to. So it's attached to your Social Security number. Whereas the I-10, the individual tax identification number, is issued by the IRS to individuals who are required to have that identification number and are not eligible for a Social Security number. So it acts almost identical as a Social Security number in the world of credit. So when we ask, how is credit even started? It started based on accounts being attached to our SSN or our I-10. And so once you've got your identification number, whether it's your SSN or your I-10, then there are two different ways that accounts can be attached to that number. So the first way is you obtaining a positive account. So you getting a credit card, a personal loan, any type of account that's reported to the credit bureaus. And then the other way that this can happen is not recommended and not the ideal way, but it's if a negative account gets reported to your credit report. So this is typically results from an unpaid bill going to collections, and then that collection agency reporting that collection to the credit bureaus. So you can establish credit that way, or you can do it the other way with you adding a positive account to your credit. So just to recap, whether you get use your SSN or an I-10 number, you can establish credit by adding an account on your own or a negative account that's been added to your credit report by a collection agency or a creditor. So those are kind of the ways that our credit score is created. And I will pause here for the interpreters. All right. So now I wanted to get into the 7 strategies for if you've already got excellent credit. So just these strategies can help you maintain that. But if you're trying to get there, these strategies can help you get to that 730, 800, whatever your credit goals require. So the first one is to monitor your credit. And this is something that you should be doing very often. There's the annual credit report that you can get for free, which kind of creates this myth that you should only check your credit once a year. But as we discussed and as you guys answered correctly, checking your own credit does not hurt your credit score. And you should be checking it often just for things like identity theft and different scams that are out there, but also just for accounts that can go delinquent without you knowing. So something going to collections or a late payment that you weren't aware of on one of your credit cards. So if you have a monitoring service, you are able to have your credit checked often and kind of get alerted when things happen to your credit that shouldn't be happening. And then you'll be able to act faster on it. So myself and my clients use a company called Identity IQ, which I will post in the chat. And there are other services out there, but you want to make sure that you're using a service that is checking your credit with all 3 credit bureaus. So Equifax, TransUnion, and Experian. Some of them will only use 1 or 2 of the credit bureaus, but you want to make sure that you're accessing your data between all 3 of the major credit bureaus. And then the second tip is one that we all know, but it cannot be missed. So just paying your bills on time. And just a story to show you guys. I had a client who was trying to take advantage of the low interest rates during the pandemic and do a refi on one of his properties. And he had a credit card that had an annual fee on it, but it was a card that he didn't use. It wasn't one that he was paying monthly because he wasn't using it, but there was an annual fee. And so that annual fee time came around, which basically it's charging you for having the credit card. So I have one of my credit cards, the annual fee is hefty. It's $550, but I get lots of benefits from it. So on the same day each year, it charges me that annual fee. And so this client, it was only about $95 for the annual fee, and he just missed that payment, which dropped his score almost 100 points. And so what that did for his refi was, once we got the late payment removed, which luckily I was able to show him how to do it on his own. Once he got it removed, his score went back to normal. The interest rates had already increased by 0.5%, but that 0.5% cost him a lot in the amount of money that he was looking to save by refinancing. He was still able to save, but just 0.5 of a percentage impacted his ability to take full advantage of the lower interest rates. But had he had that annual fee on an auto payment, then that could have been avoided. And then also, checking your mail regularly. You can get, once the collection goes on your credit report, they're supposed to notify you via mail 30 days prior. So that's kind of your chance. Once you see a letter like that from a collection agency or a creditor, that's your chance to kind of, bring it up to date or handle it before it gets to your credit report, because collections can impact your score. New collections can impact your score about 100 points also. So we all know to pay our bills on time, but I just like to highlight it. And then, get creative, find out what works for you. If that's, having a day every week, every month to go through and make sure you have everything scheduled for payment, then do that. But just find out what works for you so that you can avoid any type of late payments or collections. And then the third thing is to not close old accounts. And this is because of the average length of history that we talked about. Closing, accounts that make up for a majority of that older history on our credit report can definitely lower our average length of history, which again is 15% of our score. So, but there are times where it might be a good idea to close a credit card. For the example I mentioned earlier, that $95 and the annual fee, whereas he wasn't using the credit card, so he probably wasn't getting the value and the benefits of that card. So closing that card might have been a good idea to save on the annual fee, and then also maybe eliminate missing a payment. So definitely it's worth talking with someone in determining if you want to close credit cards or not. But on a general basis, it's not a good idea because it will impact your average length of history. But you just want to weigh your options there. And then the fourth thing is keeping a good mix of credit. So again, this is having installment accounts and revolving accounts on our credit report. So installment accounts are all of those types of loans. So it has a fixed amount. So in that car scenario, the fixed amount was the $30,000. And then the monthly payments, those were the fixed payments each month. And then the exact time frame was the 60 months. So you know exactly what you're paying, probably on the same day every single month it's due. And you have a set term that you're paying it. Whereas revolving credit is more open-ended. So you can borrow continuously against, a certain credit limit that you have. You do still have monthly payments, but those can change based on the balance that you're carrying against that credit limit. So just keeping a good mix of credit gives you that 10% of your score automatically by having installment and revolving credit. And then the fifth thing is to be strategic when you are applying for credit. When it comes to inquiries, fortunately, there is an option for us to shop around for certain types of products. So if we are talking about the installment side of things and we're shopping for one specific type, like let's say a mortgage, we can shop around and kind of apply with different mortgage lenders or brokers or banks to make sure that we're getting the best interest rate. The only thing is it has to be done within a certain time frame. So I recommend my clients just do your shopping within a 7-day period, and you can guarantee that all of those inquiries, all of those places that you shopped will count as one inquiry when it comes to calculating your credit score. So you'll see the multiple inquiries on your credit report. But if they are in that same time frame, it'll only impact your score as if it was one inquiry. So that's kind of a benefit for us, because it is important to shop around when it comes to borrowing money. Unfortunately, it doesn't work for credit cards. I'm not sure why, but it would be nice to shop around and make sure that should you need to borrow credit on a credit card and you're not able to pay it back within the 30 days, knowing that you have the lowest possible interest rate would be nice. And then the sixth thing is to keep your credit card balances low. So this is the 30% of your score that we talked about earlier. And the way to calculate your utilization is you add up all of your credit card balances and divide that by the total of all of your credit limits. So you're adding up all of your credit cards, whether it's a retail credit card or a regular Visa, MasterCard, secured, unsecured. As long as it's a credit card and it's revolving, you want to add up all the balances and then divide them by all of the limits. And that will determine your utilization rate. And for the most points in this category, you want to keep your utilization between 5 and 7%. So all of the tips out there say 30%, which 30% is great, but you'll get the most points if it's between 5 and 7%. And then the last one that I will mention is disputing negative items on your credit report. So we mentioned that paying collections that are on your credit report does not help your credit score. So if you do have collections or charge-offs, any type of negative account, even late payments, the best thing you can do besides waiting for them to fall off is to dispute them And the reason we're able to do that is because of the Fair Credit Reporting Act, which basically allows us as consumers to dispute anything on our credit report. And it requires the credit bureaus report 100% accurate information. And in the 5 years that I've been doing credit report, I've seen thousands of credit reports, and there's always something that's inaccurate on the report. And it's not inaccurate to say that the collection is not yours, or it's not, the client that I'm working with. There's different inaccuracies that can be reported on the credit report, even if it's yours and it's a valid debt. So things like late, like the date of last payment, the date opened, the balances, little line items like that can vary between the credit bureaus and vary between what it actually should be reporting as. So there's a few ways you can go about disputing those accounts, which we will talk about in the second part of this series. So this time next week on Tuesday. So definitely come back for that. But if you are, getting a head start on things, one thing I would recommend is to not dispute online. You'll see that, Credit Karma and other agencies make it really easy for you to just click a button and dispute. But to take full advantage of the Fair Credit Reporting Act, you want to make sure that you're writing them snail mail. So literally sending them a letter to the credit bureaus rather than disputing online for the best results. So just a recap of all of those. If you're like me, I recommend just taking a photo of this and reviewing it often and making sure that you're keeping up with these 7 things, but monitoring your credit, checking your credit often, doing whatever you need to do so that your bills are being paid on time, whether that's auto pay or having a kind of money date, as I like to call it, to make sure those are done. Not closing your old credit cards, keeping a good mix of credit, being very, very strategic when it comes to applying for credit so that you're able to shop around. Keeping your credit card balances as low as possible, not only for your score, but interest. We don't want to pay interest. And credit cards does not automatically equal debt. So we want to take advantage of the rewards and the benefits of our credit cards without paying interest. So keep your balances low. And then the last thing, dispute negative items on your credit report. And I'll pause for if you wanted to take a photo of this or a screenshot, and also for the interpreters. All right, so as I mentioned, it's important for you all and for me that you guys get something out of this, and for Seattle Public Library, because that's our goal here. And so in order to do so, I outlined these kind of next steps that you can take to work on reaching whatever your credit goal is. So one is to get your credit report. Again, make sure you're looking at one that's from all 3 credit bureaus. And another reason why I like Identity IQ is because it shows them side by side. So because the credit bureaus, Experian, Equifax, and TransUnion are private companies, you'll have to get your report if you're doing it from annual credit report, you get your credit report from each credit bureau individually. So then you're looking at 3 different sets of a credit report, whereas Identity IQ puts them all on one. And so when we're identifying errors in the way that the accounts are reporting, it's really, really helpful to be able to see them side by side between each credit bureau. So Identity IQ allows you to do that. But once you get it from all 3 credit bureaus, look for those negative accounts. So any derogatory marks, so late payments, collections, repossessions, charge-offs, bankruptcies, anything that's negatively impacting your score, kind of highlight those. You can look for the errors within those accounts the way that they're reporting. And then most importantly, if you see anything on your credit report that's not yours, make sure that you're identifying that. And then bring that to our next workshop on November 22nd. And we'll talk about, how to read your score or how to read your report, what your credit score means, and then give you some steps on cleaning up your credit. So if you have your credit report in hand next week, that's how you'll get the most use out of that workshop. And then the second thing is to book a credit consult with the Seattle Public Library and myself. So we'll be able to sit down virtually on Zoom and have, a 30-minute one-to-one so that you can ask any personal questions that you may have about your specific credit report, and then identify, what it is that you can do to increase your credit score, or maybe find out that your credit is great and that there's nothing you need to do. That would be awesome, right? So let's see. So the credit consults, those are 30 minutes again, and we can talk about business credit if that's more of an interest for you. You must book it online, and I think we will post that in the chat. Otherwise, you'll get a follow-up email with that information. And then I do see a question in the chat that I will read out loud for the recording, just in case someone who's watching the replay has the same question. So on applying for mortgage credit, did you say that we could shop around to different places and it will only go into the credit bureau only once? So when you're shopping around for a mortgage, each inquiry will, the credit bureaus will be notified each time you apply for that credit. However, and they'll all be reported on your credit report. So if you're looking at your report, you'll see, multiple inquiries, all of the ones that you did. But when it comes to the scoring, so kind of the behind the scenes of your credit score, those credit inquiries that are within the same time frame will only count as one. So you'll only be penalized for one, rather than, let's say, if you shopped around to 8 different mortgage lenders, rather than it impacting your score 8 times, it'll only count as one if they're within that short time frame. So I hope that answered the question there. I don't see anything else in the chat, so we could stop the recording if people wanted to come off mute or ask other questions.
Thank you, Tiara. There's so much information there.
Yes.
Amazing. We're so glad we have you helping us figure all this out, because wow, there's just so many different details that would be easy to miss.
I agree. Thanks for having me. I love talking about credit. So I hope this was helpful. Yeah, and I'm here for questions.
Cool. Well, why don't we do that? We'll do what you suggested, and we'll go ahead and finish the recording. But first, I just want to take a moment. Thank you to our interpreters. We know you've been working so hard in the background. We know there were some technical things going on, and we so appreciate everything you've been doing to work with us on this. Thank you to our captioner who's been captioning in the background. We really appreciate the work you've been doing, and we're going to go ahead and turn off both the captioning and the interpretation with the recording, so you can stop that part of it once I do that. But thank you all for being here. We hope you'll join us next week. We will also be we'll also put a link to where you can sign up for next week's session in the chat. And thanks so much, everyone.